Most people begin with the stock market at exactly the wrong end. They begin with the blinking price. They begin with a chart. They begin with a ticker symbol. They begin with a screen full of red and green numbers and think that investing is mainly about deciding whether one little line will move up tomorrow or down next week. That is backwards. If you start with a price, the whole subject becomes noisy and slightly insane. If you start with the business, the whole subject becomes much calmer. That is how I have always preferred to think before a stock is ever a stock, before a bond is ever a bond, before Wall Street turns anything into a moving quote. There is a company, and a company is not a piece of paper. It is not a symbol. It is not a rumor. It is not a prediction contest. A company is a collection of assets, abilities, relationships, and economic power organized for one purpose, which is to produce more value than it consumes. That is the heart of it. If you understand that, the market gets easier. If you do not understand that, the market becomes a giant emotional casino. So let us forget names for a moment. Forget celebrities. Forget hot sectors. Forget whether a television commentator thinks the Dow will do this or that before the next quarter ends. Ask a simpler question. What is a company? I think of it as a container filled with useful things. Some of those things are visible factories, trucks, warehouses, inventory, land equipment, cash in the bank, office buildings, data centers, machines. Some of those things are invisible. And in many cases, the invisible ones are the most valuable. A brand, a reputation, a distribution network, customer trust, a habit people built around buying from that business again and again, patents, software, a culture of execution, relationships with suppliers, a position in the mind of the customer. Those invisible things can be worth far more than the visible ones. Take Apple. Yes, Apple has buildings, supply chains, stores, servers, cash, and mountains of physical devices sitting in warehouses around the world. All of that matters. But the real magic of Apple has never been a room full of phones by itself. The real magic is that the company built such a powerful brand, such a trusted product ecosystem, and such a deeply embedded customer habit that millions of people will line up and pay a premium for what it makes. That premium is not made of steel or glass. It is made of trust and desire. That is why it is so valuable. This is one reason I tell people to stop thinking about a stock certificate as though it were a lottery ticket. When you own a share of a business, you own a tiny claim on that whole economic container, on the visible assets and the invisible ones, on the current cash and the future earning power, on the trucks and the software and the brand and the customer loyalty and the management, ability to keep all of it productive. Now, once you see the company clearly, the next question becomes obvious. Who owns that container and how do they divide the economics of it? That is where bonds and stocks come in. The public often treats these things as mysterious financial words, but the underlying logic is very simple. Imagine I decide to start a small carpentry business. Not Berkshire Hathaway, nothing grand, just me, a truck, a set of tools, some local clients, and the hope that if I work honestly and well enough, the operation can grow into something stronger than one man's labor. Suppose I have saved $10,000, that is respectable. It is not enough. The truck I need costs money, the tools cost money, insurance costs money, fuel costs money, maybe I need a trailer, some working capital, and enough left over that one slow month does not end the whole thing before it even begins. So I need more capital than I personally possess. There are two broad ways to get it. I can borrow money or I can sell a piece of the business. Those two decisions create two very different relationships. Suppose my friend Jake lends me $10,000 at 5% interest. Now I have $20,000 total. I buy the truck, I buy the tools, I take the jobs, I work. At the end of the year, let us say the business earned $50,000 after covering all the operating costs. Now comes the part many beginners misunderstand. Jake does not get to say, I would like half the profits because I helped you start. Number, Jake is a lender, he is not an owner. That means he gets what the contract promised him, his $10,000 back plus 5% interest. That is it. No more, no less. He was not there for the upside. Beyond that, he does not share in the remaining profits simply because the year went beautifully. That is what a bondholder is in the corporate world. A lender, a creditor, a person or institution that says, I will give you capital now, and in exchange you will pay me specified interest and eventually repay principal. That is a much more limited claim than ownership. It is also a higher priority claim. Suppose instead the carpentry business had a terrible first year. Suppose I made almost nothing or perhaps lost money. Jake still gets paid before I do if there is anything left to pay him with. If the truck must be sold, if the tools must be sold, if the operation must be unwound, the lender stands in line ahead of the owner. That is the bargain. A creditor takes lower upside in exchange for stronger claim. An owner takes greater risk in exchange for greater upside. That logic never changes. It does not matter whether the business is a one-man carpentry operation, a railroad, a software firm, or a giant consumer company known on every continent. The basic economic order remains. Lenders get paid first, owners get what is left. That is why I have always told people to distinguish very carefully between lending and owning. They are not the same experience, they are not the same risk, they are not the same source of return. A bond is a contractual promise. A stock is an ownership interest. If the business performs beyond expectation, the bondholder does not participate much beyond his promised terms. The stockholder does. If the business struggles, the bondholder may still recover more because he has priority. The stockholder absorbs the residual pain. That is why stocks can be more rewarding and more painful. They are residual claims. You are last in line. But if the business becomes extraordinary, last in line can be a wonderful place to stand. Now let me stay with the carpentry example a little longer because it explains the whole market in miniature. Suppose after 2 years my small business is working wonderfully. Customers are referring more customers. The margins are good. The reputation is strong. I want to open another location or hire crews in nearby towns. Expansion requires capital. I could borrow more money, yes, but perhaps I do not want to load the business with too much debt, or perhaps lenders will not provide enough. So I choose the other route. I sell part of the business. Maybe Maria buys in. Maybe Tom does too. Maybe a handful of other investors contribute capital in exchange for ownership stakes. That is equity financing. I am no longer borrowing only. I am inviting others to become owners. That means they do not have a fixed claim like Jake's loan. They now share the future of the business itself. If the business grows massively, their stakes grow in value. If the business struggles or fails, they share the pain. That is what stock really is. Not a side bet, not a magic app button, not a thing you buy because it had a good week. A slice of ownership in a real operating enterprise. Now, take that logic and scale it. A private company that first sells shares to the general public is doing something very similar. It is saying, we want more capital, and we are willing to exchange part of the business for it. That event is called an initial public offering, an IPO. At that moment, the company itself receives money from the sale of newly issued shares. That part matters because many people think all stock trading always sends money to the company. It does not. The company gets money when it issues new shares after that. In the ordinary course, the shares mostly move between investors. This distinction is important. If Maria bought part of my carpentry company in the early days and later decided she wanted out, she would not go back to the company and ask me to hand her money. She would sell her ownership to someone else who wanted to own that stake. The money would go from the new buyer to Maria, not to me, not to the business itself. That is how most public stock trading works too. Once the shares are already out in the world, investors trade them among themselves. The company may not see a dollar from that specific trade. This is why I often tell beginners to think of the stock market not primarily as a place where companies are constantly being funded, but as a place where ownership claims are being repriced and transferred. It is an exchange mechanism, a secondary market. That can sound abstract, so I prefer a simpler analogy. Think about a used car. Toyota gets paid when the first buyer buys the new car. After that, the car might pass through 5 owners over 10 years. Those later buyers are paying previous owners, not Toyota. Public stocks are very similar after issuance. The shares are already out there. People buy and sell them back and forth. The company does not receive cash every time the quote changes. So then the obvious question becomes, why do I care about buying a share from another investor if the company is not getting my money, because ownership still matters? That is the answer. You own a claim on the future economics of that business. You profit in one of two broad ways, and sometimes both. First, the market may eventually place a higher value on your ownership than what you paid. Second, the business may send some of its profits out to owners in the form of dividends. Those are the two obvious channels, and both come back to the same underlying reality, which is business performance. If the business grows in earning power, becomes more durable, strengthens its balance sheet, expands margins, improves returns on capital, or simply becomes more desirable to the market, the ownership claim can become more valuable. That is price appreciation. If the business generates more cash than it needs for operations and reinvestment, management may decide to distribute some of that cash to owners. That is a dividend. Some companies do this regularly and generously. Others prefer to retain nearly everything because they believe they can reinvest at high rates inside the business. Neither choice is automatically superior. What matters is whether management allocates capital intelligently. That is the real issue. A bad company can pay a dividend. A wonderful company can pay none. The dividend itself is not the whole answer. The economics are. Let me say something here that beginners need to hear very clearly. A stock is not a piece of paper that goes up because people chant the right slogan about it. A stock is a claim on a business. The business produces value over time or it does not. The market may misjudge it for a while, sometimes for a long while, but the market's opinion is not the same thing as the underlying economics. That is one of the most important distinctions in the whole field. The market gives you a quote, it does not give you truth. Truth lives in the business. Now, why do prices move around so much if what matters is the business supply and demand? That is the short answer. The market is a place where millions of people are constantly trying to guess the future at the same time. If more people urgently want to own a given business than want to sell it, the price tends to rise. If more people urgently want to sell than buy, the price tends to fall. That part is simple. The motives behind the buying and selling are where things become noisy. Sometimes the buying is rooted in real economic improvement. Sometimes it is rooted in excitement, momentum, fashion fear of missing out, or some other emotional event with very little long-term value. Sometimes the selling is rational, sometimes it is panic. The market does not ask each order whether it came from good judgment or a bad night's sleep. It just processes orders. That is why the price can move in ways that have very little to do with calm business analysis in the short run. If a company reports terrible earnings, people may sell because they think the future economics weakened. That makes sense. If a company announces a new product that investors believe will create significant future profits, people may buy aggressively. That makes sense too. But then there are the less sensible waves, rumors, macro fear. Social media excitement. A famous fund manager saying something dramatic. A sudden obsession with a theme. A panic caused by interest rates, inflation, elections, or some foreign event. Most participants did not care about 2 months earlier and will not care about 6 months later. All of this can move prices. That is why I try very hard to separate business value from market mood. The market is extremely useful to me as a venue. It is not useful to me as a guide to emotional truth. Most people reverse that. They let the market tell them how to feel about their own assets every day. That is exhausting and usually very unprofitable. Now, because we are talking about beginners, let me go even deeper into something that sounds obvious but is not well understood. A stock price rising does not necessarily mean the business improved proportionally. A stock price falling does not necessarily mean the business deteriorated proportionally. This is why thinking like an owner matters. Suppose the market becomes fearful for broad reasons and drags down a great many companies at once. If the underlying business you own remains strong, and if the price falls because other people's emotional posture changed, that may not be a reason to panic. It may be an opportunity. On the other hand, If the business itself is weakening while the market still celebrates it, the rising price may not be comforting at all. The public is forever mixing up popularity with value. That confusion creates a lot of noise and a lot of loss. Now let us talk about what an ordinary person should actually do with all this understanding. This is the moment when people usually expect me to reveal a list of hidden stock ideas or say something glamorous about finding the next 10-bagger. I am going to disappoint that expectation. For most people, the correct answer is much simpler and much more boring. Do not try to pick individual stocks. Do not try to outguess the market. Do not assume you are the rare exception who can repeatedly identify tomorrow's winners, avoid tomorrow's losers, understand valuation correctly, and control your own emotions through every drawdown. Could some people do it? Yes, a few can. Very few. The evidence is not kind to the average person who thinks he will be one of them. And I do not like strategies that depend on flattering a person's ego before they flatter his balance sheet. The broad market is a much better answer. This is where index funds come in. An index fund is simply a basket that owns many companies at once. According to some rule, if you buy a broad S&P 500 index fund, you are buying tiny slices of 500 of the largest public companies in the United States. If you buy a total market fund, you are buying a much broader range, large companies, middle-sized ones, smaller ones too. Either way, the principle is similar. You are not trying to decide which one of those firms will dominate next decade and which one will disappoint. You are owning the broad productive engine of American business. That is a wonderful thing. I want beginners to understand why it is wonderful. It is not wonderful because it is exciting. It is wonderful because it is humble and effective. The market is constantly reweighting itself. The winners become a larger part of the index. The weaker firms shrink or disappear from importance. New leaders emerge over time. You do not need to keep guessing all that yourself. The system does some of that work for you. Then there is cost. A good broad index fund usually has an extraordinarily low expense ratio. That matters more than people realize. Fees look tiny when stated in annual percentages. Over decades, they become a silent wealth transfer out of your future. A fund that costs almost nothing and gives you broad productive ownership is one of the best bargains modern finance ever offered ordinary people. And then there is behavior. Behavior matters more than cleverness. For most investors, a simple index approach is easier to stick with. You contribute regularly. You do not need to know whether this week is the right week. You do not need to build a new thesis every quarter. You do not need to pretend you are a full-time analyst on top of your regular life. You just buy productive ownership over time. Some years will look wonderful. Some will look ugly. Over long stretches, broad ownership of strong businesses in a growing economy has been an excellent way for ordinary people to build wealth. The exact path will not be smooth. Nothing valuable is perfectly smooth. But smoothness is not the goal. Progress is the goal. I want to say something else, because many beginners secretly hate this advice. They hate it because it sounds too easy. They think serious money must require a more sophisticated trick. That instinct is understandable and dangerous. The hardest thing about sound investing is not discovering a fancy method. The hardest thing is behaving sensibly in a way that looks boring enough to insult your ego while it builds your future anyway. That is much harder than memorizing jargon. A person can become rich through a plain index fund and patience, not overnight, not through social media theatrics, through repetition, through compounding, through not interrupting a sensible process every time the world gets noisy. That last point matters enormously. The market will test you. It will fall when the headlines look frightening. It will rise when you were certain you should have waited. It will produce years where it feels too slow and weeks where it feels too volatile and moments when every amateur suddenly becomes a prophet and tries to lure you into abandoning your discipline for something hotter. Ignore most of that. The market rewards ownership far more reliably than it rewards emotional intelligence theater. So if I were beginning today, I would want to understand 5 things. First, a company is a real economic structure, not a symbol. Second, a bond is a loan and a stock is ownership. And those are very different claims. Third, the stock market is mostly a place where owners trade claims among themselves after the original issuance. Fourth, prices move because people are constantly repricing the future, often rationally, often emotionally. Fifth, for the great majority of people, the sensible way to respond is to buy broad productive ownership through a low-cost index fund and let time do more of the work than ego does. That is the simple explanation. And simple explanations are often the most useful because the world keeps trying to complicate what is already hard enough emotionally. I do not want people hypnotized by complexity. I want them grounded in first principles. Own businesses. Understand the claim. Respect the difference between lender and owner. Know that the market is there to serve you, not to instruct your mood. Buy broadly if you do not have an extraordinary reason and extraordinary skill to do something narrower. Then wait. Waiting sounds passive. It is not passive if the thing you own is productive. A farm grows while you wait. A good business earns while you wait. A broad market of productive companies compounds while you wait. Patience is not inactivity when the assets are working. That is one of the most useful truths I know. So when people ask me how to make sense of the whole stock market, I never want to begin with a chart. I want to begin with a basket. What is inside? Who has the first claim? Who gets the residual? How the ownership is transferred? Why a person would rationally want to own the whole productive engine rather than try to guess each individual winner. Once you see all that clearly, most of the noise starts to look like what it is. And the fewer things you mistake for signal, the better your financial life usually becomes. That has always seemed to me the right bargain.